Hello and welcome to Tough Talk. Today I'll be speaking with Bluestone CEO Steve Seal. Hello, Steve. The self-employed are twice as likely as mainstream applicants to be rejected in a normal market. So as lenders are changing affordability assessments, they're working through pipeline business, and they're also tweaking their risk appetites down at the moment. Are self-employed applicants facing a much tougher market than ever before?
I think it's a great question, Vicky. I think it's also a great example of where the specialist lending market can come in and support self-employed borrowers versus the mainstream market. So I can only comment from a Bluestone perspective, but if I look at the support we give to self-employed borrowers and our own lending statistics, we have almost an identical conversion rate and approval rate for employed and self-employed borrowers through this business. And I think what that demonstrates is the way you've got a specialist lender supporting the self-employed customer group, where they've got the ability to take holistic individual assessments of client circumstances and their business profiles and really digging into the detail of those businesses. That's a great example of where we, as the specialist lending community, and Bluestone in particular, can support self-employed borrowers. So I think the landscape is actually quite positive for self-employed borrowers. It's just choosing a lender that is skilled and capable and able to support those individuals rather than having an automated kind of lending process, which doesn't necessarily have the ability to do that.
Okay, and often is sort of skimming these people out the process. So what can clients do, or brokers in fact do, for their clients to improve the chances of these cases going through?
Well, I think lender engagement is always really key. So I think positioning and engaging with the lender at the first opportunity to make sure that you're talking through those client circumstances and any challenges that brokers foresee in the business model of the customer that they're presenting to the lender. So, we particularly from a Bluestone perspective, we think back to the COVID period. I know we've largely moved on from that now, but as an example of how we can support self-employed borrowers, we were taking a forward-looking view of those client circumstances, and where we could see very quickly that those customers had returned to pre-pandemic levels, we were willing to lend on historic accounts. And I think it's about trusting those borrowers, but doing it in a responsible way and taking that individual view of each client's business and their ability to borrow.
I'll not ask you to name or shame or do anything complicated, Steve, like or anything judgmental like that. But what's going wrong at the moment for cases elsewhere in the market? What isn't working?
Yeah, I mean, it's not my place to comment on other lenders' credit profiles
right.
or lending operations. I think it's more of a general distinction between, and this isn't exclusive to self-employed borrowers either, I would argue, but I think there's a distinction for people with more complex borrowing profiles to benefit from the skill and expertise that exists in the specialist lending market, which isn't necessarily available through lenders who have highly automated lending processes and don't necessarily have the ability to take that individual view of client circumstances.
Okay, brokers report that mortgage activity levels have really dropped. They've sort of as early as October we were hearing these reports and dropping to sort of December, Christmas levels. So what's your best guess on what the activity levels are telling us at the moment?
I think it's fascinating. And I absolutely echo that we've seen a real reduction in front-end lending volumes. So, we have a range of systems available to us that we can try and judge what the very front-end market activity levels look like. And I was looking at it this morning, actually, just as I was preparing some analysis. And interestingly, what we could see is if we look at the amount of ESIS production levels, for example, pre the government's mini budget versus the amount that happened last week, in the specialist market, so the sector that Bluestone operates in, there's about a 60% reduction between those 2 points. So that's a significant reduction in that front-end market activity. And I think it's then interesting if you kind of take that data and overlay it some other data that's coming out through the market. So, for example, we're seeing a reduction in new borrowers registering with estate agents, and you're seeing an increase in customers putting their properties on the market. Now, if you take all of those things and try and analyse and make some judgments in terms of what that's telling us, my gut tells me, I'm not saying I'm right, but my gut tells me that I think that demonstrates there's a fear amongst borrowers at the moment in terms of whether or not now is the time to be taking on a significant commitment like a mortgage. And I think what you're seeing is, that fear factor of rising interest rates, decreasing property prices, cost of living increases on the horizon, stalling people's appetite to enter into a significant financial commitment right now. And I think the reason we're seeing more and more properties come on the market is people taking a proactive approach to potentially wanting to downsize or strengthen their financial position through restructuring their finances at the moment.
Right, battening down the hatches, really.
I might be wrong, but it's I think it's one possibility.
Okay, and this is the thing. I mean, I hate the word unprecedented. It's been overused in recent years, but the fact is we've got this sort of collision of factors. Can you even have a go at sort of projecting what we might see in terms of the mortgage market next year?
I think it's very difficult. I think the level of if I can even say the word, volatility that we're seeing at the moment in the market makes it very difficult to actually form any judgments. And talking to many of my industry peers, I think many of us are in the same position in terms of trying to determine and predict from our own budget perspectives in terms of what the market and the landscape is going to look like in 2023. We hear a lot of commentary from brokers about next year being the year of product transfers and remortgages and so on. But I think it will take us probably until mid to late January before we start to get a really informed view of what market activity levels look like as we come out of the Christmas and New Year period.
Okay, thanks for that. So mortgage rates. We've got to get into that. Why are mortgage rates so high right now? Because we're all aware we've been watching the swap rates settle right back down. Bluestone's offering fixed mortgage rates of up to 8.49% for home movers and first-time buyers. So, can we get into that just for a sec, Steve?
Yeah, I mean, obviously swap rates have stabilised a little since their peak, and we all know they peaked after the government's mini budget. That's many grey hairs on my head as a consequence of that experience. But they've stabilised, but they haven't returned back to the levels that they were at 12 months ago. So I think it's important to reflect that product pricing, particularly through lenders like Bluestone, who are reliant on warehouse funding and more complex funding structures, there is more than swap rates taken into consideration when we're determining product pricing. So clearly you've got our own funding costs, loss assumptions, and other factors, including our own operational costs, all of which are under pressure in the current market. So I think interest rates, if the current trends that we're seeing in the market will subdue a little as we look forward. But I think it's important that we don't see swap rates as the only factor that influences product pricing.
Okay, thanks for that, Steve. But for the clients, and obviously for the cases that brokers are handling, there's still an affordability gap that's appearing, and one that's increasingly likely to widen. How are you going to deal with that as a lender to actually make sure the business volumes keep going through?
Yeah, well, I think it's important that the first message in response to that question is that we're a prudent lender, and it's important that we have a very rigid and structured affordability model that operates through our business. Now, when I describe it as rigid, what I mean by that is we have absolute clear parameters that we operate in from an affordability perspective, as you would expect for any regulated lender. But it goes back again to that point, I think, around utilising the specialist lending community who has the ability to make judgments and interpret client circumstances individually so that we can form views within our own risk appetites and our own affordability models. But you're absolutely right. There's no doubt that the higher the interest rates are, less and less customers will pass those affordability assessments. But it's important that we don't allow that to influence our prudent lending responsibilities. And clearly, our overriding objective is to make sure that the loans that we issue are affordable as customers move forward.
Absolutely. So there's no levers being pulled or anything being tweaked at the credit assessment stage?
Not at all. Okay. Well, certainly not from a Bluestone perspective, anyway.
Okay, thanks, Steve. Cost of living crisis. Now, we're in the midst of extremely difficult times. Bluestone research out last week showed that 2/5 of adults, which is nearly 20 million people, are concerned about their financial situation right now, and debts can only climb, sadly, as the recession deepens. So culturally, obviously, we don't really talk about money in this country, which makes finding solutions to debt problems quite difficult, doesn't it? Embarrassment over finances obviously could be a huge obstacle to discussions surrounding mortgage solutions for adverse credit. So what advice strategies can brokers use to actually make sure they're getting in front of these people?
Yeah, I think it's a great point. That cultural point is really key, I think. So, in this country, I've seen this all through my career. People do not want to talk about their own financial backgrounds, whether they're good or bad. So where you've got customers with complex credit profiles and are really nervous about their own circumstances, that just further emphasises that challenge, I think, in terms of getting customers to talk about them. From a borrower perspective, I think it's been interesting actually in recent times. We've seen a lot of mortgage advisors start to do much more proactive engagement through social media channels, for example, in terms of articulating the solutions that are available for customers in various circumstances. Now, my own experience is I see those kind of things come to life through platforms like LinkedIn. I'd argue that's not necessarily the best platform from a consumer perspective because it's more of an industry networking kind of platform. What I don't know is whether or not those same brokers are utilising other platforms like Instagram and Facebook and others to kind of extend the reach of those messages. But I think the more that the broker community can do to help make customers feel confident that regardless of their circumstances, that the sooner that they engage, even if there isn't a solution available to them at that time, the sooner they engage, the sooner that those industry experts will be able to utilise that advice process to guide them in the right direction.
Thanks very much, Steve. And thank you for watching. Goodbye.